It's just the payroll party this Friday with stronger than expected U.S. employment report coming out. And ouch, gold is hurting. We have Rich from iiTrader joining us now. Rich, thanks for being back on Kitco News.
Daniela, thanks so much. Always a pleasure to be here.
Rich, the U.S. employment report for October out this Friday morning. Surprisingly much larger than expected. Were you surprised?
Absolutely. You know, with the limited government shutdown, there was going to be definitely two ways to look at the numbers. My understanding is that furloughed employees would be included on the unemployment number, but not in the non-farm. And really, they shocked us on both ends of that scale. So the rate didn't go up as much as some had thought, up to 7.5%. And then the jobs numbers, absolutely crushed the numbers. My expectations were in the 120 range, and certainly that set up for a stronger dollar immediately. Good news is bad news for the market. We saw equities break pretty good, same thing in gold. And really, this is just a carryover of currency play. And if you take a look at the shocker of the ECB cutting rates, that sets up for a weaker year versus the dollar, and that was dollar supportive. Now that's the 1-2 for gold, pressing the market lower. However, 1250 is a pretty good base of support. From now until year's end, I'd be really surprised if the market got too far below the 1250 area. I think we're going to be, sideways from here into year's end.
Rich, following the report, were there any surprises for you in the marketplace? We saw gold suffering.
No, gold really, it's interesting because in the last month you saw a range of 1250 on the low side of gold, 1360 on the top end, and right in the middle, smack in the middle of the range is 1308. That's where we came into the number. We felt that we had consolidated in coming into this week based on this particular data, and we believe that sustained close below 1300, we're headed lower. Bears are in control, and we thought, well, if we had a weak number, QE's still on the table, the market closes above 1330, we could head back up to the top end of the range. But I think the market's having its way right now. This is a stronger dollar policy. It's weaker for gold.
Rich, you mentioned you expect sideways trading, but how can investors protect themselves from further downside in the metals?
Yeah, the area that I would worry about is 1250 to 1180. And what I would say is if you have physical gold, you could protect yourself with short-dated options, and really want to protect yourself into December, where there is a potential for the Fed to taper. And if they start that early, which would be on the early end of the scale, that could be even stronger for the dollar, because we know that Royal Bank of Australia is chatting down their currency. We know Bank of Japan is weak. We know that the ECB is now cutting. That's going to be dollar supportive, and that's all that this is at this point. So you could protect yourself with downside options, short-dated stuff. Maybe go out 60, 90 days, just in case, and buy some cheap puts. Whatever you pay for those puts is your total risk on the trade, and it protects your downside risk. Because if we do get below 1180, we're going to go down another couple $100, I'd say.
And it's easy to get caught up in that positive number we're seeing. But one troubling detail from the report, Rich, shows that the percentage of Americans working or looking for work fell to a fresh 35-year low.
Oh, absolutely. Yeah, numbers are you can look at them any which way. I think if you're extremely bullish or bearish, you can pick apart the numbers and kind of make them suit your position. The thing that gold investors need to start tracking is what institutional Wall Street guys are doing. I know that a lot of gold bugs don't want to watch the Wall Street guys, but if big fund managers increase allocations to paper gold, that will support your price, and that's what got gold going up to 1900. In my opinion, it wasn't physical demand. It was that every fund manager in the world had a large allocation. So once those guys start coming back in, then you definitely want to be long in a big way. However, as a big investor, they have to forecast 1 or 2 years out. So the way big investors are positioned right now, they're forecasting low inflation for the next year.
On that note, thanks for joining us today, Rich.
Anytime. Thanks so much for having me.
And thanks for watching Kitco News this Friday. Happy trading and happy weekend. We'll see you next week.